Hello traders, and welcome to the StockGoodies Chart School. Today's lesson is on the Parabolic SAR, so let's go ahead and load one up here. Go down to Overlays, pick Parabolic SAR, and the parameters should always remain the same on this one. And these dots that are below the price in an uptrend and above the candlesticks in a downtrend are the Parabolic SAR. Okay, it's a chart overlay that shows reversal points. It's below prices in an uptrend and above prices in a downtrend. It was developed by Wells Wilder, who introduced the parabolic time price system in his 1978 book, New Concepts in Technical Trading Systems. Okay, the Parabolic SAR is really a very simple indicator. And let's go ahead and see how it works. On the message boards, I used to hear people posting, Parabolic SAR flip, positive. And, got everybody all excited, and I wondered, what are they all talking about? So I went ahead and looked it up, and this is the Parabolic SAR. The stock right here is in a downtrend. You can see that it was higher because the SAR is also coming down from a higher place. Okay, so this would have been the first holler, positive Parabolic SAR flip. Okay, now that happened right about $3.20. What you're supposed to do is buy the next day, which would have put you up on this second white candle after the gap up at about 340. Let's say you got in this day, the day after the SAR flip positive at about 340. Then you would look up here, you'd be waiting every day to see the negative SAR show up above the candlesticks, and you would sell the next day. So let's look at your potential gain on a 1,000 share trade here. Okay, SAR flips positive. You're in at about 340. Okay, it looks like about 10, maybe 15 days later, a couple of weeks later, it shows up above the candles. That's the sell signal. You sell the next day right here for about 380. So you were in at 340. You sold at 380 on this day here, the white candle. So that is a 40-cent gain on a 1,000 share trade. You just made $400 just by buying the second day of a SAR flip, selling the second day of a negative SAR flip. Okay, at this point the stock moves sideways. Not really sure which way it's going. The SAR says it's in a downtrend, but basically it's running flat. Okay. Then, here we go, SAR flip showing up all over the message boards. Volume increasing, looking good, about to break above all levels of resistance. Okay, that happened the next day. You buy at $4. This looks like about 3 weeks. It's actually closer to a month. So, you buy 1,000 share on the second day of the SAR flip, which would have been right in here at $4. You're waiting for the SAR to show up here. If you hadn't taken profit already because it broke out and then kind of pulled back here, the second day of the SR flip showed up right here, and the price at that time was about $4.60. Okay, so you are in at $4. You are selling the day after the SAR flip at about $4.60. On a 1,000 share trade, you've made $600 in about 1 month. For spending only $4,000. You spend $4,000, you made $600 in a month. That's not bad. Okay? And it's a good thing you sold the second day because it just falls like a rock. Okay? Then people are saying, okay, that's enough. It's oversold. Here's the SAR flip again. Let's get in. Here's another good example of a SAR that works really well on a chart. This section right in here at the beginning, first couple of months, was very choppy. There was no real trend other than lower. Okay, so quite possibly it became very oversold. But here you're finally trying. You could have had 2 or 3 tries. It didn't work well. Okay, but you're a believer in this indicator, so you always buy the second SAR signal, the day after the SAR flips positive. Okay, it flipped positive. It went up about 20 cents that day. So you're buying the next day. It had a very small range. Pretty good volume in this, increasing volume on an uptrend, breaking above resistance. That's another reason you're buying. Okay, so you bought the second day at 240. The SAR didn't flip negative or above the candlesticks until it got to about $3. Okay, the second day, or the day after the SAR flip, was right here. So you could have sold in a range between $2.80 and $3. Okay, so you're in at 240. You sell at, let's say, $290. That's $500 in a month. Okay, then there's one more buy and one more sell, but you go ahead and get this one because volume's picking up again. Green volume or buy volume is picking up. Okay, so here's the day of the flip. That red day, you're in the next day at, let's say, roughly $3. Okay, the SAR trends up with the price until right here. Okay, so this day right here is the reversal signal when it shows up above the candlesticks. So you are selling the next day at, let's say, this white candlestick right in the middle at, let's say, $4. Okay, so you got in at $3 with 1,000 shares and you're selling at $4. You made $1,000 profit in about a month and a half. Okay, and it's a good thing you sold on the second the day of the second SAR because it pulled back from 420 down to about 360. Okay, and here it goes again. Could have bought the SAR flip positive here. If you had bought the next day 390, you would be hoping that it would break above all this resistance in this area and break out to new highs. The Parabolic SAR works best with trending securities, like the ones I showed you in the previous couple of charts. Now those only occur about 30% of the time. That means the indicator will be prone to whipsaws about half the time when a security is not trending. Here's a good example of a stock on which the SAR doesn't work very well. It's Halo. It's a biotech stock, trades on the NASDAQ. And if you do the calculations of where you would be buying and where it tells you to sell, you would actually end up losing money in this though. And the reason for that is this chart is just too volatile. It whipsaws up and down. It has huge gaps up at the open. And it's just too choppy. This area right here, giving all kinds of false signals. Looks like this one might have worked, but so I recommend choosing the charts you try to apply the SAR to carefully. Make sure that the trend looks a little bit, if it's going up and down, just make sure it's a little bit smoother and not so, choppy like this one.